Alright, hello guys, glad to have you on board again today. I just went back from vacations and well, the market tend to have that big kind of market move just when I am getting away from it. I was totally away from computer, by the way, so I just kind of figured out something happened as the number of alerts that triggered throughout this time, but I just took out the recent days to catch up on the actual events underlying the volatility itself. So a lot of things have happened, and that's the reason why I want to do a regular a long-term update, because some of the flashing signals that we have been preparing for quite some time now are now flashing red. By red, that means not the end of the world, it's just, well, the market peak that we all have been looking for might be in front of us now. It still takes 22 days to complete, because remember, the patterns are only effective when the candle closes. It's just that looking at all the volatility alerts that we have seen in some places, like Apple and the like, which weights too much in the S&P 500, I am willing to say we rather like to be cautious and not necessarily wait until the candle close to take actions. So I'm going to take the risk of potentially being proven wrong by the next 22 days. Okay, so that's really the assumption, and I think even if that were to happen, it probably will be confirmed by the month afterwards or the run right after. So it's pretty much, I guess, anyway, happening right in where we were expecting it. Remember that considering the long-term forecast, remember there's no way to cheat the market on those long time frames. Best case scenarios, you can go crazy shit for 3 to 4 years or 3 years at best, and then it all comes back down to earth generally violently. So what we've experienced with the S&P 500 is we have a long-term massive trend. Remember that in those kinds of things, the best we can get are pullbacks. There's no bear market in the S&P 500, durable bear market. So we have strong and painful consolidation. Certainly we do have those, and we expect one to happen in the forthcoming years. We're going to try summing up all the consequences of the pending signals. So the first one is that's an exit pattern. So that means it isn't going to validate anytime soon, because it takes up to the trend channel to get the validate. Currently, the trend channel is stating at $4,000 on the S&P 500, or 4,000 points, and we're far off this level. I don't intend thus to get out there anytime soon, but it is important to me to figure out that this signal is lining up almost perfectly with the actual Armstrong cycles, which is something that I use in my general market allocation strategy, among other kinds of general grand scheme of things patterns like the Ray Dalio, world dominance systems, and all sorts of things. So we've been flashing this major peak, major cycle peak. Okay, so it's not something short-term cycle bottom or whatever. It's really a major cycle peak that's going to lead us up down to August 28th. So this is really something that is going to impact forecast for the next 4 years. So that's something we really want to be talking about. It's not going to play out throughout the next few days. It's not going to play out throughout the next few weeks. It's going to play out throughout the next few months, quarters, and years. And it is really something that you need to kind of assess. Okay, we're long-term playing it here. That's for portfolio managers, not for short-term traders and stuff like that. Okay, so now all the prerequisites are lined up. Let's get into the important stuff. So first of all, remember, background trend means all the best we can get down so far is a pullback. I actually question the viability of eventually getting that pullback back after 2021's excessive stupid bull market. We had that as an extension. Remember that we are in something that looks like a wave one extended, which means we've made an extension of this pattern with a very likely possibility to build an overlap support in this. Though remember that this cycle peak that you see in here is expected to bottom up, which means cycling bottom opportunity is about to be 2028, so far off in the distance. Though, are we going to get a straight line correction for the next 4 years? Of course not. But remember that the market is cyclical by nature, and despite external catalysts fucking it all up, there are very slim chances to actually get something comparable to 1987 or the COVID pandemic. So remember that anything can come and hit the market from the outside world. That's a possibility, and we live into constant tension and uncertainty. So I don't mean to forecast the future, just saying if anything comes and fucks it all up, what are the technicals suggesting in terms of probability? So first of all, market top, which means concentration has happened very dramatically throughout the last few months. We have assessed those irregularities for several months now, and we've particularly assessed these two throughout the eyes of RSP to SPY ratio, which has gone to extreme range boundary in this long, big monthly range. We've gone to an area in which it was absolutely stupid to be bearish. And remember that basically says the concentration of a handful of names which impact the SPY, which is market cap weighted, against the RSP, which is equal weighted 1/50th for each and every S&P 500 component. So basically in here that just tells us the stupid concentration which we're in. The violence of the shift is historical, in a sense that the only time in history which we had a similar kind of shift has been the other way around, following the debacle of 28. So that's basically the opposite that we had back then, which means the immense concentration that we had during the crisis has been fueled by the extreme opposite of market diversification following suit. Now we had the opposite, which means coming out from one extreme, we've gone straight down to the other with extreme violence, concentrating the gains. So remember that what's going to come out of this is the huge opposition, which means we very likely stand much higher than the opposite in here. That's visible by the clear bullish orientation of that moving average. So we're not going to stay there very long. It can be a multiple month occasion, so don't call it a V-shaped reverse kind of opportunity. Looking at the taking profit pattern that we have, that we can eventually even try to inch a bit lower. So call that the end of the tech bubble. Very likely will happen because we have all the evidence that we need to fight against it. But is it already the bottom? Can we already leverage our calls and stuff like that? Not that yet. Quite not there yet. Okay, the other huge asymmetry that we have seen in terms of actual market divergence is the ratio between growth and value exposition in the S&P generally, which means IVY versus IVE and IVW, sorry. And basically what we've seen in here is that was a much more interesting trade to make, because this one provided the third range boundary against trading the opposition of just trying to fight and crash the big techs, which is inevitably going to happen, but how hard it is to actually time that event doesn't pertains for us to trade. But in here, a nice third range boundary has much better risk limitation. So that's the reason why I said there's one thing for sure, is that if we head into stagflation, which all evidence seems to show, and I'm going to argue about that, the thing is that the best trade to make now is to get rid of all growth. It's to get into the value names, the boring stuff that bring some safer kind of revenue models than the crazy growth stuff which we were into. So it's not just about the big tech. It's really big tech is one part of the problem, huge one. A second problem is the market diversification among portfolios, strongly overperforming growth and strongly overweighting growth in their portfolio exposition, which is going to cause a lot of problems. And though that means we're probably switching to something less fancier, but that's just the tip of the iceberg. Another final kind of divergence that we've seen is the stupid arbitrage between the US and China, where the US is actually the falling kind of world dominance, where the China is the rising power, and it's absolutely stupid to kind of play this game. So it's been leveraged by absolute bullshit kind of stuff, trade wars and all sorts of negative consequences like that. But one thing is for sure, this is a divergence pattern. When winds terminate, it's going to take a few years to get back to normal, and we're going to get right back down to the average of that range. There is no bearish dynamic here visible by the orientation bullish of the moving average on the intermediate consolidation. So what we have in here is a big flat fucking range, which means after two bearish consecutive wave, expect two bullish consecutive wave and strong overperformance of China over the US in the coming decades. We're really long-term thing here. But remember, we squeezed all of this by a stupid divergence. We're now exit pattern already confirmed, waiting to get out of the squeezing pattern. So not necessarily going to be a big flash and a big pop. It's just going to be potentially a boring 45-degree angle kind of consolidation, V-shape reversing on the long term, but basically look like those kinds of boring, slow channels that I am expecting in the other direction. Okay, waiting for this. So these are the three big divergences. Now, why am I talking about inflation and in the United States and therefore stagflation? Because what we're going to have in the next 4 years is a recession. We're clearly going to visibly say that by looking at the fundamental metrics, which we've highlighted, by looking at the yield curve. So the yield curve has made what we didn't want to happen, and we said if it happens, I'm going to severely increase my odds of recession in the coming 2 years, and that's exactly what just happened. I said if we get back there again and if we break that resistance, that's the end of it. That means to me now 100% of recession by the next 2 years, and it's probably going to happen sooner rather than later. So I would tend to say it is stated to me somewhere around 6 months to 2 years. But the market, the bond market yield curve is signaling a recession in the next 2 years as literally inevitable by now. Though is it going to be 28 over again? Absolutely not. We have underlying pressure that suggests that it's not the case. And this time around, it's also visible by the fact that we are still in extreme long-term monetary restriction territory, visible in here by the long-term end of the yield curve, which is far from being collapsing it now. It could very well happen. Don't get me wrong, I don't know it for sure. But as you can see in here, like during COVID, we quickly have switched in here to monetary accommodation, just as such as we did in 2008. I don't see any evidence of this because we still haven't created any such a thing as a third range boundary that creates the risk limitation to go lower. Though it could happen, that's really a risk factor. And if we switch to deflationary kind of recession, 2008 and critical also stuff like that, like 2000 crashes, COVID and whatever, we're going to see those kinds of problems again, only if this one falls off the cliff. For now on, I don't have reason to think of it because the 10-year yield is still locked in here. And remember that the 10-year yields will never be priced below inflation rates. And there's one problem that we're going to have to talk about right now. It's the commodities. It all flashes bullish all over the place, which suggests that this time around, don't expect any such a thing as a deflationary environment. If we do have hard commodities, remember the previous cycle that topped up in 24 was locked in an embrace of very bullish soft commodities like grains, fetal cattle futures, and all sorts of stuff going bonkers. Now we're going to have the rising of the second cycle of inflation, which is coming from hard commodities like metals, industrial metals like silver, platinum, all sorts of boring stuff, critical materials like remix kind of rare materials. All these kinds of things are flashing tremendously interesting bullish signals on long-term time frames. But once again, even though the retail traders are heavily buying into those assets, silver and petrol, remember that the market makers just can't go against the wind. They can try to blur the lines and try to trap you in, break out some supports if you put too tight stop losses or whatever. But just like people were trading the USD JPY for long periods of times, they were massively selling USD JPY. And I told you, be patient. They're probably right. When the tides will turn, they will flash to be bullish, which is exactly what happened. You've seen those huge news with now the BOJ has been raising interest rate without prior notice, and it's really been taking the market by surprise, flashing up like the end of the actual carry trade, which means this is really something that's been playing out for more than a decade now, which is terminating. And it's really going to take a lot of time to unwind, so don't call it a crash like we're all going to die or whatever, slim chances to ever happen. But in the interim, what it says is that this is yet another domino in the falling sequence of events for the dollar, which is basically yet another source of external financing has just dried out now, which means the final carry trade is now being unwinded, and there are tremendous amounts of billions of dollars that's going to have to be winded out of the system to get back into repaying those yen debts. And that's really one thing that is going to fuel even more inflation, as the dollar will lose its strength even further. And it's already been pretty weak, even against the euro, as so many people were calling for the parity to happen, and it was just full of shit. That was a tremendously good opportunity to buy. And I think the USD JPY as well is now signaling on the monthly to quarterly chart time frame, because this is a secular bear market trend, as you can see. And we've attempted to kind of counter-trend these trade through the help of the actual carry trade, which has been played in two cycle waves, supporting all the recovery phase back in 28 and the second stupid bull market that has happened since 2020. So that's really the way it goes. It's been the way to finance the US stupid bonker shit of pulling all the money into a handful of names and all sorts of stuff. That's been the sum of many factors, catalysts pulling the US economy where it is now, overvalued territory all over the place. So this huge concentration, this huge disparity of value to growth ratio, this huge disparity against China, all of this has been fueled partly because of the carry trade. So the carry trade being now terminated isn't just a one-off switch. It's going to take several years now to unwind, but as we're trying to forecast whatever is ahead of us for the next 4 years, this is something that we need to expect. And a bearish trend, we're going to go right back down to support, and we're going to go there violently. First thing I can say is that putting back to the moving average is almost guaranteed at that stage, and it can happen pretty violently. So be very cautious and be ready for a wild ride. That doesn't mean it's going to happen. It just means we're going back down there. So there is significant shift into the USD JPY ratio that can account for 30 to 38% retracement. And it's a significant move, because that means whoever has exposition from one side or the other of the aisle is going to have to hedge against that volatility. And we're talking about huge forex market volatility in here when we switch 30 or 40% valuation between two big economies like that. So the thing is that euro dollar instead is printing pretty mild moves, very accumulated, and I've been telling you to be very cautious about these two for the latest years, and I maintain this worrisome kind of forecast. If you just were to look at the volatility of this, you would see in here that we're looking at 2.5 standard deviation. If you look at the entire history of the euro dollar, there has never been such a squeeze, which means the volatility is extremely low, a massive movement into down the corner, and I very well would like to say it. Everybody in the US think the Eurozone is going to explode, whatever shit like that. They've been saying it for decades now. It never happened, and it probably won't. The thing is that I think the dollar instead is going to collapse, and not necessarily disappear, but just lose a significant portion of its dominance in the world, even against the euro. And to me, I've always said it's a temporary stuff. We're probably going to get back down to this 1.10 area. But if we ever want to challenge it again and eventually go lower and go to parity, we're going to have to go 135 first. We're going to have to create that 3rd-range boundary, folks, and that's all it is. We've had a background bullish trend. There's no way to go lower without a retracement first. So we're going to go there if you ever want to go there afterwards. That's the nature of the business. This thing is much more bullish than bearish, and don't ever be bearish in something that goes higher. It's stupid to me. So I think the dollar is much more to lose. It's been losing significantly against the yen, and it's going to be continued. But it's very likely going to start to trigger versus the euro at some point. Is it going to do now? Not necessarily. As you can see, this squeeze in here is probably going to touch both boundaries and create some volatility before it actually starts to trigger. So I think it's going to trigger by 2028 for sure. But is it going to be short term? I guess not. So the idea here is just to bear that one in the back of your head. Say, why would I have to trade euro dollar if it's going to be a very complicated asset to navigate? So first and foremost, the thing that I recommend, and I do personally, is if we ever retrace to this lower Bollinger Band, I'm going to buy eyes closed. If it doesn't, am I willing to buy breakout out of this? The answer will be yes, eventually, upon some condition and with limited amounts. The condition will be, do I have signals of cycle breakouts or stuff like that? Which means breaking out now? No, I'm not going to get it in this. Breaking somewhere around like 26, I probably will follow suit. That would be the sign that we're breaking this monthly cycle eventually. So not now if I have to break out trade euro dollar. I'd rather like to buy on the support as we'd have much better risk limitations there. The second thing is I'm going to buy anyway. With a breakout or pull back to the support is a mandatory because, like I said, we're talking about significant shifts in here as well, which means for 25% shift, that's far less than for a Japanese investor who's definitely going to have to hedge. And this is the reason why they're rebuying all these kinds of dollar-denominated assets that they bought. So be very cautious with that. It's going to pursue and it's going to continue doing. The euro will have to do it at a later stage, I guess. When the dollar will start to lose value against the euro, all European investors will have to do exactly the same as the Japanese ones do now. They're going to have to pull out their assets from the US economy, and they're going to have to hedge against the potential backlash from forex exchange rates, which means the euro dollars, the traders are going to have to unwind their positions in the US to go back and repatriate that into euro valuations, which means they're going to sell euro dollar, or they're going to sell dollar euro. They're going to buy euros for dollars. Okay, so that's what I think is going to fuel. Like I've always said, the US is now alone in their stupid shit. There's no way for anyone else to buy their debt now. You're locked into an emotional embrace of thinking that you're going to bring the rest of the world down with them. And like I've always said, it's not going to happen. The US are going to fall solo, and they're going to try bringing the rest of the world with them, but it's not going to work this time around. The problem is the US isn't going to disappear. People think like this is a binary thing, like China is taking it all and the US is losing it all. That's not how it works. It's a binary kind of bipolar world that we're going to get ahead. The US isn't going to die. It's just going to suffer stagflation and dollar withdrawals, which means we're going to get back to the means. And that, to me, that means in here, that means back to the USD JPY. And what you need to understand out of this is against major currency, the dollar is expected to lose 25 to 30%. Roughly averaged, which means that's the DXY losing 30%, and it's clearly visible that it's very likely going to happen there as well. So by losing 20-25% on the dollar index against major other currencies, that means the problem is commodities will start rising crazily because almost all of it is going to be inflating in the prices of USD WTI. Same thing goes for silver, which is denominated in dollar for those kinds of contracts, platinum, and sorts of things. But remember that stagflation isn't just the denominated asset value by the denominator going down. It's also that there's going to be higher prices globally, not just for the US, globally of any hard metal commodity and metals for most, which means we do face a double banger in here. That means for the US, the value, the global value of those hard commodities, metals like silvers and the like, are going to raise for everyone. But it's going to take an even harder stance for the US because they're going to add up a 25% devaluation on the dollar. And accounting that they do not produce that much silver and no platinum and they do not have access to rare metal, it's going to be a sizzling effect. A very, very bad effect for the US economy, which is to me going to force them into that stagflation. That means the US isn't going to recess like crazy, crash and lose 15% GDP or whatsoever. I just think the GDP in the US will be compensated mostly by the actual real inflation, and the dollar-based kind of inflation is going to be fuel. As the world is de-dollarizing, importing things in the US is going to cost a lot more. And we're talking about, over the next 4 years, somewhat like 25% shifts. It's enormous to absorb in a 4-year timescale, even more so as the commodity themselves are rising for everyone else. It's really how it goes, and that's the dangerous part of it. That means WTI for the US citizens could very well rise back up. So let me just get rid of the Bollinger Bands in here, but it's very well expected to rise back up to $100 and so. And as you can see, some of it is going to be caused by 25% of dollar valuations being denominated, but the rest of it is probably going to be fueled by actual commodity inflation, which everyone is going to suffer, not just the US. But the US is going to suffer it twice harder because they will fuel by the dollar denominated devaluations on top of. And by doing this, you understand that the US is locked in somewhat of an embrace. It's a somewhat mild recession because it's not a crazy kind of thing where everybody's going to go down. It's just a kind of recession that's going to force the bubbles to pop. So it's going to recorrelate all these problems, which means the weighting of the big name in the S&P 500 is going to be severely diminished back to normal levels. It's not going to crazily go the other way around, but just neutralize, which means the overweighted assets that we have in the S&P 500 are going to underperform the S&P. And they're not going to crash now. They may for some, but the risk in here is mostly to underperform the S&P 500. And as the S&P is expected to contract, then that means the huge valuations, the Apples, the Amazon and the like, they're expected to even overperform the downgrade. They're going to lose more than the S&P does. That also means that some portion of the S&P, specifically the value, may actually overperform the S&P, which in some words could actually be positive. Because remember, one thing that people don't understand with stagflation is that in stagflation, the asset prices don't go up. Because some assets go down, certainly. And one thing is for sure, is stagflation destroys margins. So the problem is high margin growth names, like specifically the Amazons and all sorts of stuff, are going to be destroyed by the rising cost of commodities. Though these big assets who trade at absolutely bonkers shit kind of valuations, they're going to take the hardest hit because they're going to be hit by inflation and de-dollarization of the world. But the problem is their actual revenues may still rise in dollar because they're international companies, which means when the dollar loses 20 or 30% valuations against external currencies, when their profits is actually made somewhat in Japanese yen and all sorts of other currencies, when they're exchanging it back to dollars, they're actually making somewhat of a profit, or they're raising more dollars as a revenue. So remember that the revenue of those companies may actually keep rising, even though their margins will get crushed. But the market will trade the margins on those big names. So I expect all the fancy big names to take severe hit in the next 4 years. Some may eventually crash like Apple, who are absolute bunker shit bubbles. Though that's really the thing. Same thing goes for Nvidia. They're going to go crashing territory, and here as well. So all the overvaluations are going to correct dramatically, and some may eventually crash at the later stage, I think closer to 2028. So not necessarily forecasting this to happen now. Commodities rising, forex hedging taking full force, and complex market arbitrages below, happening below the surface, which means it's not just like selling the S&P 500. The S&P 500 may actually slightly correct due to the actual overweighting of just a handful of names that may be going down, even though revenues may be somewhat stable, but actually devalued by the denominator in here. So the value is going to go down. But the thing is that for all the value assets, which are already trading somewhat like PE ratios around 5, which is something that we only see in severe recessions and crashes. So most of the value names are already trading stupid bonkers shit. Like I could take some examples like PayPal or whatever, it's just trading like it's already dead. It's actually a profit-making company. It's just crazy fucking shit there. So I think those kinds of assets have very likely probably not to just perform the S&P 500, but actually make some profits, both in value and also in dividend dividend yielding. So the thing is that in a stagflationary environment, investors suffer inflation instead of deflation. So holding cash isn't going to make it any easy. If you're just thinking, okay, I'm going to sell it all, wait until the pullback happens, I'm going to buy it again, it's not going to happen. One thing that this thing says is get the fuck out of the big names. That's the most dangerous trade and most crowded trade to be in. Not to mention, Warren Buffett just sold 50% of its Apple weighting. Jesus, man, do you want more evidence that it is really time to get the fuck out of here? I mean, not mentioning any other names, but really Buffett has been the most successful investors of all time. And if this guy is now loading up 50% off for this asset, that might be the sign that the best is already there. There's only one worse thing to come. Consolidation is the best option for Apple. Crashing is an eventuality as well. But be very cautious with that. Very speculative there. And it's not going to happen anytime soon, I guess, if such a thing has to happen. And it's not going to do in a day. But remember that on the other hand, there is a value trade to be made, which means even if the S&P might go down, what you want to be doing is eventually hedging against S&P 500 consolidation. Don't go crazy. But eventually, if you have a portfolio bullish on weighted assets for value names, you might want to hold on to this. The thing is that these guys won't go bullish. Don't expect them to break any resistance. Most of the time, you're going to buy very boring assets, which are trading at the bottom of a range, and you're going to be targeting just like a range trade, which means wherever you reach out the halfway of that range, which means in here, for example, for PayPal will be somewhere around 50% fib is 150. The 50% context line is at 130 and the moving average is at 86. So kind of average these three and you would see that if you ever reach out 115, you really want to be taking your profits. But there is a very nice profit margin to be made in between. So it's really these kinds of boring assets which people have been left over for quite some time now. We're trading at significantly low PE ratio, contrasted to the massive headliner names like Apple have been trading 35 or 40 PE ratio with totally topish kind of revenue model. So it's really not that kind of thing. It really tells a lot about the violent recorrelation arbitrage that's going to happen. And it's really all about that. The recession that we're going to get isn't the kind of thing we just sell, wait, and buy cheap tokens afterwards. It's really not how it works. It's really more like it's going to be a recorrelation asset, totally unwinding everything that has been happening since COVID, which means it's going to be a rotation to value. Get the hell out of here of growth. It's going to be a rotation out of big names into some more leftover kind of less fancier names down in valuation at low PE ratio. It's not going back to cash because inflation is going to suffer a lot for those who are holding this cash. You're not going to be able to put it into treasuries which don't yield enough to compensate. So, and most over, there are going to be default probabilities. So be very cautious with that. Okay? Investors will likely look for those low value names which have been left over and they're going to look for those profits, which means crowded trades may happen there and it can be very volatile. So you really want to be setting some limit order trades to get the hell out of here very quickly. Don't wait for too long, okay? And if you do this, remember what we said earlier, if you have a bullish exposition to the United States and if you're not living into the US, you want to be hedging for the forex exchange costs, which means you can't just be a European investor and buying into the US without hedging in the euro dollar. If you're a Japanese investor, same thing goes on with USD/JPY and all sorts of things, depending on wherever you live on earth, you're going to be hedging against the dollar devaluation. It's really all there is, okay? Remember that the US isn't going to crash. All the bond market's saying for now is that a recession is inevitable within the next 2 years. What it says is that this recession isn't going to be a crazy one. It's a mild kind of recession, much more look like moderate stagflation. Somewhere like unemployment numbers are going to rise. It's going to put a lot of pressure on the bottom end of the actual working force. It's going to be facing potential unemployment consequences. So of course, the fuel that is supporting the US economy, the consumer, is going to be crushed. A stagflationary environment is just anything that is consumer related is going to be crushed. That one more thing says Apple is in deep shit. So really we'll have all this problem. Consumer kind of assets, get rid of them, really. It's not going to be a pleasant 4 years for the United States. You're going to suffer high import costs all over the place, rising cost of goods, rising inflation, base inflation coming from productive costs. That doesn't mean the economy recesses as a whole and collapses. It just means the economy slows down. It still remains with higher prices, which means stocks may not crash. They may actually maintain or rise in valuation, but mildly. And it isn't going to be at a profit for actual investors unless they hedge for the forex costs. Okay? And for a US investor, isn't going to bring external additional purchasing power, because if you make 25% on a stock and you're actually using 25% purchasing power in the dollar, you just made yourself net zero. And that's really all there is. Remember that for US investors, investing in the market isn't going to be an option. They're going to have to do it. They're going to lose so much external purchasing power, they're going to have to buy assets. So that's really the way to go. Understand, it's not an easy kind of market to work with. It's something that none of current traders have experienced in their lifetime, or they're being close to retreat now if they're doing so. And what they experienced in 1970 is nothing compared. It's not the hard kind of stagflation as it was back then. It's more moderate, which means some of the behaviors are going to replicate. It's probably going to destroy all the absolute bunker shit kind of decorrelations that we've seen. It's going to recorrelate, which means it's not just doing stupid thing, it's just doing the reverse kind of trade of these actual decorrelation. Though this is more the kind of market in which you want to be an arbitrager or in a stock picker, and you really want to be acting quickly and swiftly, which means whenever your targets are rich, take the fucking profits out of here. Don't stay for too long. When the actions are happening, I expect volatility on single assets to be enormous. I mean, for example, your asset can make a 25% on a day, reaching out to your targets, and if you're waiting for one more day, you're going to lose 10% out of this. So be very swift in action. When your profits are reached out to, put some limits order to make sure you're executed on the desired price. Okay? Don't wait and don't raise your expectation because of volatility or whatever shit like that. Reach your target. Don't try to find the top. That's just how it goes. Don't try to buy at the low. Don't try to stay at the high. Just arbitrage and take your targets in. Lock the profits as quickly and swiftly as you can. It's going to be a volatile and bumpy road for the next 4 years. Nonetheless, it isn't a crash that is expected. It could happen if external factor catalyst like a world war emerges or stuff like that, but for now on, we don't have any evidence of it from the bond market. The market isn't going crazy, and if it does, this is the kind of charts you want to be looking at. And if this one goes bonkers and crosses below the mid average, you have problems to handle. But that means you probably will figure that out all by yourself by looking at the news. Nevertheless, it's really improbable when we look at the context we have. It says low volatility, so there are very likely chances for us to find some support in here, range a bit more. So if shit is to happen, I don't see it happening in the near term. Could change in the distance, but if ever, I will let you know. Very cautious. Forex is now going to enter the game, and if you are in an outside US area, you really want to be hedging it if you're investing in any US company stocks. Remember that there's also a big hedge to be made against China, which is probably going to terminate the same decorrelation pattern, but this one has happened longer. This one has been stating since 2015, and remember this one is going to take longer to unwind. So it may take up into 2028 to get rid of these actual decorrelation patterns. But that's one good thing. Like if you're really looking at diversifying portfolios, getting to limit your exposition to the US and diversifying a bit more into China might be one very wealthy trade to make. So remember, that's going to be arbitrage. I mean, don't just blindly get into China. It just means if you're selling some US stocks and want to redirect, that could be one trade. You're actually being bearish on the US and actually being more bullish in China. So that's really all there is. Reallocating capital or hedging. I mean, basically you're selling the Dow Jones and you're buying the Hang Seng instead, and you're making that kind of arbitrage trade. Same thing goes between big names and small names. Get rid of the big names, stay into the small names. Get rid of growth, fall into value. That's really how it goes, okay? And of course, when these trades reach out their targets, lock on your fucking gains, okay? When you reach out to some support in here, don't be dumb enough to wait for retracements to take your profits, okay? So if you play these arbitrages, they're really in, out, hello, goodbye stuff. It's probably going to play in multiple sub-cycles, probably coordinated with the cycles that we have seen, which means I expect some swing to terminate somewhere around June next year, where some profits should be taken, then let it retrace until somewhat like June 2026, and then take it all the way back down to August 2028 to terminate the pattern. Okay, so this is really how it goes. Be very cautious with that. I expect generally the pi cycle peak to be the extreme area for volatility, which means expect some bumpy road between June 2027 to August 2028, but we're really far off in the future, and we'll have a lot more opportunities to talk to each other until then. So from now on, stick to the essential. The US is dipping into recession, and it's not the kind of recession you used to have. It's not just sell it all, waiting for prices to dump and buy again at cheap prices. It's not going to happen. You're going to be forced to invest. Even for external investor, investor, getting rid of the US is not an option. But if you invest in the US, value, get rid of the fancy fucking names, hedge your portfolio against the forex costs, be ready to load up some commodities. Specifically, if you're a US citizen, you really want to be loading into those hard commodities. Gold is already pretty expensive, so remember that the silver to gold ratio is at an extremely low level. So if you want to buy into metals, it's really getting out of gold. It's not worth it for now on. Most of it is already locked in. Going for silver, platinum, or any other rare earth metal, like the Remix kind of chart. It says a beautiful potential. It's potential delayed third range boundary, which means in here that we'll be going from context to context, building a high low point, and boom, that means we're going to go straight up to break the previous high point. That's a target in the near 4-year term to be somewhere around 158. We're currently trading 38. So remember that 25% of it is going to come from the dollar, but the rest is a massive, staggering 3x gain. So I think it's a very risky bet. So remember, the bigger the target, the lower the exposition in the portfolio this have to be. But I think, yep, going into the hard commodities is the best hedge for US citizen. It's also a nice trade for all the other folks out there, but make sure that if you do trade those dollar denominated assets, you're getting yourself hedged 1-to-1 against the denominated value of your trades into a euro dollar trade hedge. Same thing goes if you're USD-JPY if you're into Japan, I don't know, AUDNZD if you're in Australia, and all sorts of things like that. I hope you get it. So this is how to navigate these things. No financial advice, of course, just telling everything that I do personally, and you get to hear what you want with your own portfolios. It's just that I try to explain just how complicated navigating these next few years will be, and how the fact that throughout the latest few years, it's clearly been visible that some major excesses have been the aftermath of the 2020 COVID pandemic, which has basically been fueling with free cash and a lot of unexperienced investors joining into the market like it was a casino. I think these guys are going to be wrecked in the following years. That means it's not the bear market kind of stuff which they can heavily just reverse their position and get rich. No, it's the kind of thing, it's going to be boring, range, volatile, arbitrage kind of stuff, professional management portfolios. A lot of people are going to make a lot of mistakes, and I very well then bet they're all going to get washed out of it by the end of it. I guarantee you, I've seen that happen a lot in the past. I've studied history of markets a lot. These kinds of speculative, stupid behavior are always temporary. We started this in 2021. That's when people get fully crazy about markets. We're now 2 to 3 years into it. That's the top of it. The retails are going to be wrecked, and those who are gambling in the market like it was a casino are going to suffer massive losses from now on. It's a specialized professional market again. Now the smart money is going to take it, and those who are not well suited for this are going to suffer losses. This is the end of the easy market, folks. I'm not sure it's going to happen now. It may be in a couple of months, but I have all the evidence and signals saying it's not going to be pretty, folks. For targets in the S&P 500, you're going to make it easy. This is a long-term trend, so the best you can hope for in terms of retracement is a kind of pullback, typical stuff, which means a full bearish cycle, which I get this time around will finish, not looks like it was like down back then. So now this time around, expect retracement down to 23% fibs, so 4,500 or so is going to be a first target for massive profit taking. Remember, if you're bearish on the S&P, don't target anything below those fibs. First one is 4,500, and the second maximum target to me is 3,800, and I don't think we can ever go anywhere beyond that. If we do so, that means the big names are crashing, and I don't see that happening for now. So we'll see that one again, and we'll eventually get to talk about that when the pi cycle peak happen. This is where the top risks will happen. This is where potential crashes on big names like Apple and the like could eventually start to trigger. Until then, be very cautious with that. Don't be overly bearish. Don't be overly bearish. Remember that the VIX is going to remain elevated, which means if you are kind of day trading, please, folks, don't do it. If you thought you were a good trader and just have less than 3 years experience, fuck it, man. It's really a good time to take your money out, severely reduce your exposition to the market, and learn the hard way how to work. The easy money isn't going to happen anytime soon, and those out there who say printing money to infinity and free cash is going to be there again, the parable of bullshit folk like that, I have clear evidence these guys say bullshit. The chart says entirely the opposite all the way around, and these are professional skill stuff. The bond market don't lie, and the bond market says recession is headed, and it's not going to be a pretty environment for those who think we're going to go bonkers bananas to crazy shit valuations like that. When it comes to crypto, same thing. If you load it up into speculative bullshit assets, you're going to take some massive losses. So be very cautious with that, folks. Easy money isn't going to happen anytime soon anymore. And it's going to be 4 years to flush out the dumb money who's been coming into the market for a fancy ride post-COVID. The easy money is no longer. Now it's hard-earned money from professional skill sets. If you're not suited for this, get the hell out now instead of losing your gains. All being said, I'm going to leave you guys with that to avoid a too long video. Be very cautious. I can't stress that warning enough. Be very cautious, folks.